Before we start this video, do like and subscribe to our channel and not miss on any updates.
So far we have understood about how to account for dependent branches, how to account for independent branches. In dependent branches we saw the datas method, the stock and datas method, the P&L method. Then we also saw what to do when it is done at cost price, what to do when it is done at invoice price. Then we saw independent branches. We also touched upon the concept of wholesale pricing, right, where the head office sends the goods to the branch at something called as wholesale price. Then we also saw how to account for transaction between the head office and the branch whenever something is missing, something is not yet accounted, what is to be done in that case. Now we'll move on to the next important aspect of something called as foreign branches. Before starting foreign branches, you must ensure that you have completed accounting standard 11 so that the concepts that we are discussing here is more clearer to you. Okay, so if you have not completed accounting standard 11, I would suggest you to complete that first and then continue with foreign branches. Now, what are foreign branches? As the name itself suggests, these are branches which are located in some another country. So, if you are someone from India, let us say we have a head office in India. Something, let us say a branch you have in US. So, this will be a US branch. This will be a foreign branch. Similarly, there could be cases, let us say, for example, you have Amazon US. If Amazon US has a branch in India, they actually have a subsidiary, but I am just giving an example. If they have a branch in India, for Amazon US, the Indian branch becomes a foreign branch. Okay. Now, as far as foreign branches are concerned, there are two aspects. One, to compute the profit and loss earned by the branch, that is the first thing. Second thing is, the currency of the head office will be different from the currency of the branch. Say for example, Indian country, we follow rupees. US branch will do all the transaction in USD. Now at the end of the year, what is our objective? To find out the profit of the entire company. So if I have a head office in India, I will do my transaction in rupees. My branch, which is in US, will be doing its transaction in dollar terms. What is the objective at the end of the year? I need combined P&L for head office plus branch. Now, as far as head office is concerned, everything is in INR, I have no problem. Branch transactions are happening in USD, head office is sending something from India to US, that will be accounted for in INR. So, at the end of the period, you have a branch trial balance which is in USD. This USD trial balance has to be converted to Indian rupee, and that is where we need to have an understanding of accounting standard 11. How to convert transactions in foreign currency to our reporting currency. Alright, so the thing that will be different here is you have a foreign branch trial balance which is not in INR. So, first objective is to convert that trial balance to INR and then prepare the P&L of head office and the branch. Now, like we had in domestic branches or inland branches, we had dependent branches, we had independent branches. For foreign branches, we have something called as integral foreign operation and non-integral foreign operation. So, this is what? Integral. This is what? Non-integral. Now, what is the difference? As the name suggests, integral means something which is integrated, something which is like a part of the head office. For example, if I say this is my body, my hand is integral to my body. So, I cannot say my hand is something separate. I am treating the hand to be part of my body. So, same way in case of integral branches, head office and branch, we treat as if branch is an extension of head office. Like we have dependent branches, here also we have integral foreign operation. The branch is just like an extension of head office. Head office has opened a branch just for maybe for the purpose of complying with local regulation, but largely everything is controlled, directed, done by head office. So, these two entities are a single entity kind of a thing. Whereas in case of non-integral foreign operation, this is where the branch is treated separate. There may be transactions between head office and branch, but branch is doing things largely independently. Head office has done some investment, branch is managing its own operation, branch is taking its own decisions, branch is buying on its own, branch is largely dealing with, let us say, USD currency. Whereas in case of integral operation, head office might be sending goods to the branch, branch will remit money back to head office immediately or within a specified period. Whereas in case of non-integral foreign operation, the branch will work as if it is an independent entity. So that is one difference you need to understand. Now because of this difference, when we prepare the final accounts of the head office and the branch, the translation also is different. Now what is the meaning of this translation? For example, we have branch trial balance. In branch trial balance, we have income, let us say $1,000. We have expenses, let us say $800. We have assets, let us say $500. For example, this branch trial balance has to be converted to Indian currency. Now, don't directly jump into conclusion saying that if something is in USD, it is a foreign branch. Sometimes the institute asks questions saying the USD office is the head office, Indian office is the branch office. So, don't jump into conclusion saying that if it is dollar means it's a foreign branch. That may not be the case always. Okay. Now, I gave you some examples: income, expense, assets, there may be liabilities also and all of that. Depending on whether it is an integral foreign operation or non-integral foreign operation, when I convert, see my objective is what? To convert this dollar into INR. To convert this dollar into INR. If it is integral foreign operation, there is a separate way of conversion. If it is a non-integral foreign operation, there is a separate way of conversion. First, let us see quickly how to do if it is an integral foreign operation. Okay. Now, what did I say? Integral means it is like my part only. It is the part of my body only. It is not separate. So, if there is an integral foreign operation, when I do the translation, I will do as if I have entered into the transaction. I am repeating once again. If it is an integral foreign operation, I will translate the trial balance. Sir, what is the meaning of this translation? Conversion from one currency to another currency. Whenever I do the translation, I will do as if it is my own transaction, as if I have entered into the transaction. What is the meaning of that? Say for example, income. Here income is $1,000. If I had a foreign currency income of $1,000, what would have I done as per AS 11? Considering the date of transaction, I would have converted. So, income, I will consider what is the date of transaction, and accordingly, whatever has been the income, I will convert that into INR. So, let us say this $1,000, when this transaction happened, the exchange rate was 80. So, I will multiply it by 80 and I will say income is 80,000. As if it is my own transaction. Okay. Then, expenses, same logic. Assets, as if I have purchased the asset. What do I do when I purchase an asset? On the date of purchase of the asset, whatever is the value, I will consider that. So, let us say when that asset was purchased, the exchange rate was 90. So, I will multiply it by 90 and I will show it as 9 into 5, 45,000. If there is a monetary asset, I will do restatement at the year end. So, here also I will do a restatement at the year end. If there is a monetary liability, I will do the restatement at the year end. If there is a non-monetary liability or non-monetary asset, I will carry them at the transaction date cost. Okay. So, that is how we do the translation. On doing the translation, there will be some difference. Why? Because 1000 I converted at 80, 500 I converted at 90, expense I will convert at some other rate, there will be some difference. If I enter into a foreign currency transaction and there is a difference, exchange difference, what do? I recognize in P&L. So, any difference will be accumulated in P&L as if I have done the transaction. So, the logic of integral foreign operation is convert everything as if you have done the transaction. Now from examination point of view, what will happen is income or revenue you would have earned throughout the year. You will get single rate called as average rate. Similarly, expenses also you will get something called as average rate. Assets, you will get the rate of date of transaction. Okay. Sometimes what may happen, asset you may do a fair valuation. Let us say as per AS 10, you have done the revaluation model. Then on this date of fair value, what is the exchange rate? You will consider that. Okay. Similarly, inventory. If you are valuing it at cost, you will take date of transaction. If you are valuing it at NRV, you will check what is the date of NRV and on that date what was the rate. So basically, to break this down, everything is done as if we, the head office, are entering into the transaction and accordingly we will do the conversion. Okay, this is the underlying logic. Now what we will do, we will take up a question and we will try to solve it so that we have clarity on how to convert integral foreign operations. So to summarize, if we have integral foreign operations, then we will take the trial balance of the foreign operation and branch. So whenever we have integral foreign operation, what do? If you have opening stock, either you will take the rate on date of purchase if available, or you will take the closing rate of previous year, that is the opening rate of the current year if you are following NRV. So this depends from question to question. If the rate on date of transaction is available, you will take that. If NRV was followed, assume for a moment, previous year we valued the inventory based on NRV. So what is the date on which we computed the NRV, we will take that rate. But typically the questions will have something called as opening rate. So we will take the opening rate only. Closing stock. Question generally will give us closing rate, but if we have rate on date of purchase, we will take that rate. Monetary items, all the monetary items, closing rate only. All the monetary items, closing rate only, because as per accounting standard 11, all the monetary items like debtors, creditors, okay, all of these have to be valued using the closing rate only. Purchases, sales, actual rate on the date of transaction, but because there will be many purchases and sales, we will take the average rate. Fixed asset, actual, or if you have done the fair valuation, the rate on which the fair value has been done. Okay, so depending on that you will do it. Just keep in mind, for opening stock and closing stock, either you will take the rate on which those inventory have been purchased if that is given. Otherwise, what you will do, you will take the closing rate assuming it has been done using NRV. Once we do a couple of questions, you will get clarity on how to check the rates. If there is any exchange difference on the translation, we will take that to P&L. Okay, so let us take one question. Let's now have a look at the question. On 31st December of year 2, the following balances appeared in the books of Chennai branch. So the branch is in India. That's what I was saying. Don't jump into a conclusion saying dollar means foreign. Okay, so here they're saying Chennai branch of an English firm having its office in New York. Head office is in New York. So the branch currency is rupee and the head office currency is dollar. Stock as on 1st of January 234. Purchases and sales, both are given. Debtors and creditors are also given. Bills receivable, payable, salary and wages, rent rate, taxes, furniture, bank account, New York account. New York account means this is the account of head office. So the branch is saying I have to pay 5,99,150 to the head office. Stock on 31st December was 637,500. This is the closing stock. Branch account in New York books showed a debit balance of 13,400 on 31st December of year 2. Now what does this mean? This means that in the head office account, accounts, they are saying branch account balance is 13,400. Now if I have to translate this New York account to dollars, this is in INR, I have to convert this into dollars. I will not take any rate. I will simply take what is the balance of Chennai branch in the head office books. So instead of this, I will directly say 13,400. and furniture appeared in the head office books at $1750. Now what does this $1750 represent? Maybe when they had purchased, this was the value, or after purchasing, after depreciation, this is the carrying amount on cost basis. So for furniture also, I will not do any conversion, I will directly take $1750. The rate of exchange for $1 on 31st December of year 1 was 52, so that is previous year end, and 31st December year 2 was 51. Average rate for the year was 50. Now why is this average rate given? For all the transactions that happened during the year, we will consider what is the average rate, which is 50. Prepare the head office books, the profit and loss account and the balance sheet of the branch, assuming integral foreign operation. So what is the thing we need to do? We need to take these numbers, we need to convert that into dollars, considering the rates given. So what should we follow? For all monetary items, closing rate. For purchases, sales, expenses, we will take the average rate. Now for stock, they have not given us what is the stock, purchase date and all. So for that, for opening stock, we will take the opening rate. For closing stock, we will take the closing rate. If actual rate was available, we could have taken the actual rate as well. Now, when you get this question in the examination, first thing is you have to convert this trial balance. You have to convert the trial balance. Okay. If you convert it properly, then there is no problem at all. Alright. See, it's a tallied trial balance. We'll convert this trial balance and then considering the numbers, we'll prepare the P&L and balance sheet. That part you will also be able to do easily. Okay. So the most important part is conversion. So working note, conversion or translation of Chennai branch trial balance. Okay. So I'll just note down the rates: opening rate, closing rate and average rate. Okay. So what's given in the question? Opening rate is 52, closing rate is 51. So opening rate is 52, closing rate is 51, average rate is 50. Okay, that's what I've said, right? Average rate is 50. Now, again, closing rate will be used for all the monetary items. Average rate will be used for the transactions during the period. Fixed asset, we will take actual rate on the date of transaction. The dollar amount is directly given to us. Opening stock, closing stock, if actual purchases information is available, we will take the actual rate. If that information is not available, we will take the opening and closing rate. So I have just copied the table as it is. You can note down the table when you are doing the question, right? So I'll just note down the rates here. What is the applicable rate? Stock on 1st of January, opening rate. So we'll take 52. Purchases and sales. Purchases and sales, average rate 50. Debtors and creditors. Now debtors and creditors are what? They are monetary items. So we'll take the closing rate of 51. Receivable, payable, monetary items 51. Salaries and wages, average rate 50 because it has happened during the year. Rent rates and taxes 50. Furniture. Now furniture will take actuals as given to us in the question. Bank account, is it monetary item or non-monetary item? Bank account is a monetary item. So we will take the closing rate. New York account we will take again actual information that is given. So let us see how much is the number in debit and credit in dollars term. Okay. How to convert? Always remember, $1 is equal to 52 means if I convert from dollar to rupee, it will be more. And if I convert from rupee to dollar, it will be less. So if I have to reduce or if I have to make it less, I have to divide. Simple way to, remember. Sir, why are you asking us to remember? Because in examination, you should not be confused. Logically, you know that if I have to convert rupee to dollar, I have to divide. But in examination, under stress, sometimes we may get confused whether to multiply, whether to divide, especially when some unknown currencies are given. So from rupee to dollar, it has to come down, we will divide. 23400 divided by 52, 23400 divided by 52, if I do, I get how much? 450. Alright, I get how much? 450. Then purchases and sales. So now let's do the conversion. First 234 divided by 52, 4,500. So, stock is 4,500 debit. Then we have purchases and sales. 1562 500 divided by 50, 31250, 31250. Sales 2343 750 divided by 50, we get 46875. Then debtors and creditors, 765 divided by 51, we get 15,000. And 510 divided by 15, we get 51, we get 10,000, straightforward. Then 204 divided by 51, 4,000. 178 500 divided by 51, 3,500. Salaries and wages, 1 lakh divided by 50, so 2,000, straightforward. 106,250 divided by 50, 2125. Furniture 91,000, they have given us directly the rate 1750, so we will directly take on the actual basis 1750. Bank account 568 650 divided by closing rate of 51, 11150. And head office account directly we will take how much? 13,400. We will take 13,400. Now what happens is, when you do this translation, because we have converted different amounts at different rates, there will be a difference. That difference will be taken to P&L. Sir, what is the logic? I am considering as if the head office has done the transaction. Any exchange difference because of the head office transaction, foreign currency transaction, where do we take that? We take it to P&L. So here also whatever difference has come cumulatively, that will go to P&L. Okay. So let us do the total. 4,500 plus 31250 plus 15,000 plus 4,000 plus 2,000 plus 2125 plus 1750 plus 11150. I get 71775 on one side, 71775 on one side, 46875 plus 13,500 plus 13,400, I get 73775. So what is the difference? 2. So what is the difference? 73 minus 71, 2000 is the difference. Now this difference, is it a gain or a loss? Now very simple way to see. Credit is more, debit is less. Liabilities have become more, assets have become less. Now this 2000 I will write on the which side? I will write on the debit side. So on the debit side I will write 2000. On the debit side I will write 2000. I will write 2000. So if I am writing something on the debit side, what does that represent? Loss. So that will be a loss, and total will be 73775. Here also you will have 73775. This is the first step. If you do it correctly, rest of the question can be done easily. Okay. Now let us prepare the trading P&L. Now in trading P&L, like we normally do, first we will take the opening stock to opening stock. Now right now we are preparing in dollar. Okay. Opening stock is 4,500. 4,500. So this 4,500 is done. Purchases 31250. 2. Purchases 31250 by sales 46875. 46875. So purchases and sales are also done. Debtors, creditors will come in the balance sheet. So simultaneously you can also prepare the balance sheet. So we have debtors, how much? 15,000, creditors 10,000. So debtors 15,000, creditors 10,000. Okay. Then bills receivable, payable 4,000, 3,500. Bills receivable 4,000, bills payable 3,500. Done. Then salaries and wages, these are all what? P&L items. So we can directly write the closing stock by closing stock. How much is the closing stock? Closing stock was 637,500. Closing stock is how much? 637,500. Now, at what rate should we convert? Do we know exactly on which dates we have purchased? No. We could have taken the average rate, but again, this may have something from the opening. We don't know whether they have done NRV and all. So, please make a note of it. If information is not given, then we'll take the closing rate. What is the closing rate? 51. So, you take closing rate of 51. 637,500 divided by 51, you get 12,500. Make a note of it. If closing rate, if details of closing stock is not given, we will directly take the closing rate. So, in the balance sheet also we will immediately write closing stock 12,500. How much is the gross profit? 46,875 plus 12,500, 59,375 to gross profit carried down minus 31,250 minus 4,500. We have 23,625, 59,375. All right, then by gross profit brought down 23,625. After that we have expenses, rent, rates and taxes. That's it. To rent, rate and taxes. How much? Rent, rate and taxes 2,000. Then did they mention anything about depreciation and all? They have not given or they have not mentioned anything on depreciation. If depreciation information was given, we would have provided depreciation as well. Okay. Then we have nothing else. We have salaries also, sorry. Salaries and wages 100,000. That when we convert, we got 2,000. So, rent, rates and taxes is actually 2125. My mistake. Rent, rates and taxes is 2125 to salaries and wages 2,000. So, to salaries 2,000. Done. Then, if you come to the trial balance, we also have this 2,000, that is your exchange loss of how much? 2,000. So, that exchange loss also has to be booked to exchange loss 2,000. So, how much is the net profit? To net profit 23,625 minus 2125 minus 4,000, we get 17,500. So, this is the net profit. Where will you take the net profit? You will take the net profit to the balance sheet. Okay. Now, coming to the balance sheet, we are left with what? Furniture 1750. So, write down the furniture number. Furniture, how much? 1750. Then bank account closing balance is 11150. All right. Then do we have any other liabilities? Bank is done, furniture is done, everything else is done. Then you have the head office account, New York account. Now, New York account is having a balance of 13,400. Add net profit. Net profit is basically branch has to give me the profit ka share. So, how much is the net profit? 17,500. 17,500. So, 17 plus 13 is 30,900. If you do the total, 30 plus 10, 40, 4,900 plus 3,500, it is 4,4400. Credit side, asset side 1750 plus 19,000 plus 12,500 plus 11150, you get 4,4400. So, if you look at this, once you know how to convert, then preparing P&L and balance sheet is not a challenge at all. Okay. So, the most important part is to pick the rate correctly and to calculate this difference. After that, rest all is what you have already learnt in CA Foundation, CA Inter, in your 11th, 12th, same thing, same logic will be followed. And if you get these questions in the examination, you have a great chance of scoring 8 out of 8 or 10 out of 10 because hardly any scope of making mistake in this particular type of questions. Let's now have a look at the next question. Very, very simple question. Once you know the principles, you just need to identify the correct rate and do the conversion. Okay. S&M Limited Bombay have a branch in Sydney. So Sydney is the branch. Sydney branch is an integral foreign operation. So far they have been asking questions only on integral branches. Okay, they have not yet asked question on non-integral. But what we will do is later, using the same information, we will see how to convert or how to treat this if this is a non-integral foreign operation. Okay. At the end of 31st March, the following ledger balances have been extracted from the books of Bombay and Sydney. So they have Bombay and Sydney information, capital, reserves, land, buildings, all these assets, all the expenses and all of that. Now if you see building depreciation reserve, what is this building depreciation reserve? It is nothing but accumulated depreciation. Then you have branch stock reserve. What is this branch stock reserve? Any unrealized profit in the branch stock. Okay. Right, then goods sent to branch is there, managing director salary, wages, rent, office commission and branch head office current account. The following information is available. Stock on 31st March, Bombay 1,50,000, Sydney 3,125. So this is the closing stock of Sydney branch. Okay. Again, if information of opening and closing stock, the date of transactions are not available, opening stock convert using the opening rate, closing stock convert using the closing rate. You are required to convert the Sydney branch trial balance into rupees using the following rate of exchange: opening rate, closing rate, average rate and for fixed asset. This is just for your understanding. In examination they will not give you that. Opening rate you will use for opening stock, closing rate for closing stock and all monetary items, average rate for all the transactions, fixed asset the date on which the fixed asset has been purchased, so you will use the rate of 18. You have to convert what? Sydney into INR. So what is the rate applicable? We will see. So first item, plant and machinery is 200. Now plant and machinery is 200 in dollars. What rate should we use? The date on which we purchased this plant and machinery, the rate was what? 18. So we will use 18 as the rate to convert the fixed asset balance. So plant and machinery, we will use the rate of 18. Okay. Depreciation is also considered and calculated considering the rate of 18. Cost also at 18, depreciation also at 18. So the plant and machinery depreciation reserve will also be converted using 18 because depreciation is calculated on cost basis. So think of it, if I had purchased the plant and machinery, I would have recorded it at 18 into 200 and accordingly depreciation also I would have computed using 18 into 200. Alright. Then debtors and creditors, these are monetary items. We will take the closing rate of 24. Then stock, opening stock, we will take the opening rate 20. Cash and bank balances, this is using again 24. Purchases and sales, average rate during the year 22. Now goods sent to branch, goods sent to branch. Head office says 100, branch says 5. What is to be done here? Now here, goods sent to branch, the head office knows I have sent at 100,000, that is 1 lakh. Branch has recorded it at 5, maybe at that point of time 5 was the rate. How to translate this? See, if the head office knows I have sent goods worth 1 lakh, I have sent goods worth 1 lakh. So then the same amount we will consider for conversion. We will not do this average rate translation because head office knows the cost of goods sent to the branch or the value of goods sent to the branch is 1 lakh. So we will take 1 lakh directly. Managing director salary is only for head office. Wages and salaries throughout the year we will use the average rate. Rent, average rate. Office expenses, average rate. There is commission receipt, again average rate. Current account, whatever is the balance here, the same balance we will consider for translation. So let us do the translation. I am doing it here only. Okay. In the examination also you will note down all the items. You will note down items in dollars, use the rate and then do the calculation. Okay. So first item, plant and machinery. So 200. 200 into 18. So 18 2s are 36. 36. 100. 200 into 18. 3600. Then 130 into 18, 2340, 2340. Debtors, creditors, 24 into 60, 1440 and 30 into 24, 24 3 is 72, 720. Then stock 400, 20 into 20. Then cash and bank balances at 24, so 240. Purchases and sales at 22. So 20 into 22, 440, and 123 into 22, 2706. Goods sent to branch, it is 5, we know it is at 100, so we will take 100 only. Then wages and salaries at 22, 45 into 22, 990. 990. Rent, 12 into 22, 12 into 22, 264. Office expenses, 18 into 22, 396. Then commission receipt, 100, 100 into 22, 2200. Head office account, there is no items in transit and all of that. Please remember, it has to be the reconciled amount. Okay, so we'll assume it's the same number, 120. Don't write on the debit side because it's a credit balance. So you will write 120. All right. So let us do the total. 3600 plus 1440 plus 400 plus 240 plus 440 plus 100 plus 990 plus 364 plus 264 plus 396. We get 7870. Okay, we get 7870. Write down with pencil. Firstly, 7870. Then 2340 plus 720 plus 2706 plus 2200 plus 120. We get 8086. How much is the difference? Minus 7870. If we do, the difference is 216. So credit side is more. We will post the difference on the debit side. How much? 216. So here we will put the difference 216. That is exchange loss, and the total is done. Okay. After that, like we did in the previous question, if you want to, you can prepare the branch P&L separately. You can prepare the head office P&L separately. Okay. So 216 is the loss and the balance sheet is tallied, right? Then let's look at the next question. Mrs. Carling has head office at New York, USA, head office, branch at India. Now here again, branch is Indian branch. Mumbai branch is an integral foreign operation. So they have said it's an integral foreign operation. Mumbai branch furnishes you with the trial balance as on 31st March and the additional information is given below. So they have given us information of the various items. Stock, purchase, debtors, bills of exchange, wages, rent, sundry charges. Sundry charges means expenses. Computer, bank balance, New York office account. Okay, all of that is given. Also here, they have, in the previous question that we did know, they did not give us depreciation. They should have given depreciation amount separately as well. If depreciation amount was separately given as a P&L item, you will consider 18 of rate to do the conversion. Okay. Computers were acquired from a remittance of USD 6,000 received from New York head office. Head office is New York. They gave how much? $6,000. Now that $6,000 would have been spent to purchase the computers. They have said computers is at 240. As far as the New York head office is concerned, when they translate this trial balance, they will simply say these computers are at 6,000 minus depreciation. Depreciate computers at 60% for the year. So they have not given when did they purchase. They have simply said depreciate it at 60% for the year. So for the year depreciation will charge 60%. Unsold stock of Mumbai branch was 4,20,000 on 31st March. What is this closing stock? Rates may be taken as follows. 1st of April 40, 31st March 42, average exchange 41. Now all the information in the previous two questions what we did, similar information is given. Conversion in dollars shall be made up to 2 decimal accuracy. So we will have to do it till 2 decimals. You are asked to prepare US dollar the revenue statement. Revenue statement means the P&L account for the year ended 31st March, balance sheet on that date of Mumbai branch as would appear in the books of New York head office. You are informed that Mumbai branch account showed a debit balance of 39609.18. 39609.18. So this account balance 1620 when we convert will get 39609. These numbers are in thousands. Okay. And there were no items pending reconciliation. So this is the amount we will take and do the computation. Alright. So very simple, nothing complicated. So what we will do? First we will take the trial balance, convert that in using the relevant exchanges rate. and then prepare the trading P&L and the balance sheet. So again, like we did in the previous question. So let's do this. The opening rate is 40, closing rate is 42, average rate is 41 as given in the question. So we'll convert it. Now when you are doing it in the examination, you will write all of these items as it is, write the debit item, credit item and do the conversion. So what I am doing is, I am converting here itself. Okay, you can do the same way to convert to avoid any confusion. Okay, so what is the rate applicable? That's what we need to know. Stock rate is 40. Okay, then purchases and sales, will take the average rate 41. Debtors and creditors, closing rate 42. Bills of exchange, closing rate. Wages and salary, average. Rates and taxes, average. Sundry charges, average. Computers, actual. Bank balance, closing rate of 42. Head office account, actual. That's what we have to do. Okay. Now these numbers that they have given is in what? INR. The numbers that they have given is in INR. This has to be converted to dollars. Which dollars? I think it's a US dollar. Okay. So let us do that. Amount in dollars. Amount in dollars. Debit and credit. Okay. Stock on 1st of April 40. So this is in 1000. So what you have to do? 300. We have to first multiply it with 1000 and then divide it by the respective rate. So 300 into 1000 divided by, what is the rate? 40. So it comes to 7500. Then purchases and sales, 800 divided by 41 into 1000 if I do, it comes to 19512.195. So I can round it off to 19512.20. Then 1200 into 1000 divided by 41, we get 29268.29. 29268.29. Please be careful in rounding off. Sundry debtors and creditors, 400 divided by 42 into 1000, we get 9523809. So we can write 9523.81. Creditors, 300 into 1000 divided by 42, 7142.86. 7142.86. Bills of exchange, 120 into 1000 divided by 42, 2857.14. 2857.14. 240 means into 2 times. So 240 into 1000 divided by 42, 5714.285. 5714.29. Wages and salary, 560 into 1000 divided by average rate of 41. 13658.54. 13658.54. Then 360 into 1000 divided by 41. 8780.49. 8780.49. 160 into 1000 divided by 41. 3902.44. 3902.44. Computers, they have said to consider actual. Actual was how much? 6000. Then bank balance, 420 divided by 42, 10,000. And New York office actual, so 1620 is what we have. In the question, what they have given? 39609.18. 39609.18, that is what has been given. 39609.18, this number. So here also you will write 39609.18. Okay. So now let's do the total. 7500 plus 19512.20 plus 9523.81 plus 2857.14 plus 13658.54 plus 8780.49 plus 3902.44 plus 16,000, you get 81734.62. 81734.62. Okay. Sir, why did we not provide depreciation? depreciation is an adjustment. In the trial balance, we have not yet provided depreciation. So, it should be treated as an adjustment. Come to the credit side, 29268.29 plus 7142.86 plus 5714.29 plus 39609.18, we get 81734.62. 81734.62. No difference. So, the question has been framed in a way as if there is no difference. There is no difference. Now, what I want you to do is pause this video, prepare the trading P&L account on your own and the balance sheet on your own, and then continue watching this video so that you also have a practice. Okay. So, once we are done with this, directly we can jump into preparation of the trading P&L. Okay. So, we will have trading P&L account followed by the balance sheet. In the next page, you can have balance sheet. There is no rocket science in what we are doing now. To opening stock, how much? 7,500. To purchases, how much? 19512.20. By sales, how much? 29268.29. By closing stock, how much is the closing stock? Closing stock, if you look at it, unsold stock is given to be 4,20,000. 4,20,000 you will convert using the closing rate of 42. So, 4,20,000 divided by 42, how much we get? 4,20,000 divided by 42, we will get 10,000. So, by closing stock, 10,000. How did we get this? 4,20,000 divided by 42. Alright. So, closing stock we have 10,000. Then, so we are done with purchases and sales, we have done with stock, we have done with closing stock. Are there any other items? We have this item called wages and salaries. See, in real life actually there is no great difference, but we have been taught since 11th, 12th and all of that. If wages is given first, treat it as wages. If salaries is given first, treat it as indirect expense. So, wages and salary, we need to note how much is the wages and salary? 2. Wages and salaries, it is 13658.54, 13658.54. Apart from that, there are no other expenses item. Okay. Now, on the credit side, if you see, you have 39268.29, 39268.29 minus 7500 minus 19512.2 minus 13658.54, you get minus 1402. Oh, means there is a loss. So, by gross loss, how much? 1402.45. So, this total will be 39268.29 plus 1402.45. It is 40670.74. 40670.74, and this side also 40670.74. Okay. So, you will bring down the loss to gross loss 1402.45. Okay. Then we have what? Rent rates, sundry charges and depreciation. Okay. To rent, rate and taxes 8780.49, 8780.49. To sundry charges 3902.44, 3902.44. Then on computers we have depreciation. To depreciation. How much? 60% of 6,000. 60% of 6,000, 3,600. They have not given whether it is an opening balance, what is the cost and all of that. We will assume current year only we have purchased and full year depreciation we need to provide. Then we have computers done, bank balance in New York office account, that is it. So, 1402.45 plus 8780.49 plus 3902.44 plus 3600 If I do, I get 17685.38 by net loss 17685.38. This will be transferred to the balance sheet. Now come to balance sheet, very simple and short balance sheet. What do we have? We have computers. Computers, 6,000 is the cost, less depreciation 3,600, 2,400 is the computers. So we are done with computers. Bank balance is 10,000. Bank balance is 10,000. Closing stock is also 10,000. Closing stock is 10,000. So bank balance is done. Then on the credit side, also we have debtors and creditors also, right? So debtors. How much is the debtors? Debtors is 9523.81. 9523.81. Then you have head office account. How much is the head office account? 39,609.18. 39,609.18 minus loss. Okay, this loss has to be reduced. 17685.38. 17685.38. So minus 39609.18, if I do, I get 21923.8. 21923.8. Then we also have creditors. How much is the creditor? Creditors balance is 7142.86. 7142.86. Then we have bills receivable payable. Receivable 2857.14. 2857.14. Bills payable. Bills payable is how much? 5714.29. 5714.29. So let us see whether it tallies or not. 2400 plus 10,000 plus 19,523.81 plus 2857.14. We get 34780. 34780.95. 21923.8 plus 7142.86 plus 5714.29, we get 34780.95. See, once the trial balance is tallied, you may make some mistake. For example, in depreciation you may make mistake, but because both side impacts are same, your balance sheet will always tally. Don't think that if balance sheet is tallied, your answer is correct. You may have made some error and still it may have tallied. Okay, so but 34780 is the total of debit and credit. I hope with these questions you are now comfortable with how to handle integral foreign operation. What should we do? Once you get the trial balance, identify the rates. What is the opening, what is the closing, what is the average? Opening stock, opening rate unless other information is available. Closing stock, closing rate. Monetary items, closing rate. Sales, purchases, income, expenses item, average rate. If head office account is given, you will directly take the head office balance. Okay. Then if some fixed assets and all, if they are purchased on a specified date, you will take that rate only. Convert the trial balance. Any difference, balancing figure will be treated as exchange gain or exchange loss. Where will you take that exchange gain or exchange loss? In the branch P&L account. Okay. That's about integral foreign operations. Now that we have understood how to translate trial balances of integral foreign operations, let's now move to non-integral foreign operation. Now, what is non-integral foreign operation? Integral means it is closely integrated. It is like an extension. Non-integral is more like independent. It is more like independent. And one thing that you have to understand for non-integral foreign operation is that the intention generally is to hold it for a longer period of time. Cash flows will not happen between the head office and branch on a continuous basis. It is more working like independent. So I have invested in a non-integral foreign operation. It will continue to operate. And when I dispose it, that is when I get the significant amount of cash flow. Okay. So how do we convert non-integral foreign operation? As I told you, they have not yet tested these questions in the examination. We will use the same example that we have done earlier and see how to convert. The principle for conversion is very simple. All P&L items, average rate or actual rate, and all balance sheet items, closing rate. All balance sheet items, including fixed asset and all of that. Now you may ask, sir, why are we using closing rate? The idea is to present saying how much will I get if I sell off the branch. If I dispose of the branch, how much will I get? So all the assets, all the liabilities, I can realize only at the closing rate, correct? So that is the idea, we take the closing rate. For current year transactions, for P&L, we will take the average rate or actual rate, okay? So using the same earlier question in one of the examples that we did, if we consider this is a non-integral foreign operation, then what will change? Opening stock, we will continue at opening rate only, because previous year we would have done balance sheet items at closing rate, okay. Purchases and sales, P&L item, you will take average rate, so this will remain the same, this will also remain the same. Debtors and creditors closing rate will remain the same, bill of exchange closing rate same, wages and salary also same, rent rates and taxes average rate, sundry charges average rate. Now coming to computers, what will we do with computers? We will not take this actual investment, we will take this closing balance of 240 and divide it by closing rate. We will divide it by what? Closing rate if you are following non-integral foreign operation. So it will be 240 thousands divided by what was the closing rate? 42. So this will change to 5714. This will change to 5714 if it is non-integral foreign operation. Bank balance will remain the same. Head office account, we will take the closing balance as per the branch. Then there will be some difference. Whatever difference arises, please understand, it is not my P&L. Why the difference in treatment? In integral foreign operation, I am doing the transaction. So whatever is the exchange difference is my P&L. Whereas in non-integral foreign operation, I am not doing the transaction. I have made that investment. Branch is doing the management. So any exchange difference I am not realizing immediately, that will not go to P&L. Any exchange difference will accumulate in foreign currency translation reserve. Foreign currency translation reserve. And when we ultimately dispose of the branch, that point of time we will realize this in P&L. So when we talk about non-integral foreign operation, all balance sheet items at closing rate, fixed asset, everything at closing rate, all P&L items at the actual or average rate, difference in trial balance, it is TRIAL, is transferred to foreign currency translation reserve. The foreign currency translation reserve balance will be carried forward in the balance sheet till the concerned branch operations are shut down, closed or disposed of. So it will be an item in the balance sheet as foreign currency translation reserve. Year on year you will continue. Okay. So that is how you will do the non-integral foreign operation. So that is the difference. Largely questions have been asked on integral foreign operations only. They have not been tested on non-integral foreign operation, but we should know how to do if it is a non-integral foreign operation. Now, how to decide or determine whether it is an integral foreign operation or non-integral foreign operation? Generally, it will be given to you in the question. There are some indicators which will make a branch a non-integral foreign operation. Okay, so first one, control by the reporting enterprise. So, if the amount of control is very high, if the head office is controlling the branch fully or 90%, 95% control is by the head office, then that becomes integral. If control is less, it becomes non-integral. See, if I made an investment, of course, I control that enterprise, but who takes the operating activities, who takes the decision with respect to operations, what to buy, where to buy. So, considering that, you will decide. Second, transaction with reporting enterprise are not a high proportion of the foreign operation activities. What is the meaning of this? Say for example, 100% of goods are sent by head office to the foreign branch. Then you can say it is an integral operation. But in non-integral, it is very less proportion. The transaction between head office and branch is very, very limited. Then it becomes non-integral. Third one, activities of foreign operations are mainly financed by its operations or from local borrowings. Basically what it means is, once you have started the branch, the ongoing financing of operations is done by the local borrowings or it is done by the cash flow generated by the branch. Head office does not keep on investing in the branch. The finances are raised independently and they are not dependent on the reporting enterprise. Reporting enterprise is, okay, I have started the branch. After that, I have given you initial capital. Post that, use that capital, generate profit and run the branch. Don't come back to me again and again asking for money. If the branch comes back to head office continuously asking for money, head office, I made losses, please give me money. Head office, I need to buy fixed asset, please give me money. If that happens on a continuous basis, then it is integral operation. Foreign operation sales are mainly in currencies other than reporting currency. Maximum sales happens in, let us say, dollars if it is a foreign branch. All the expenses by foreign operations are paid in the local currency. All the expenses of the foreign branch is happening in foreign currency. Day-to-day cash flow of reporting enterprise is independent of the foreign enterprise cash flow. So, whatever the head office has generated as cash flow, that is independent of what the branch is doing as cash flows. What is the meaning of this? If it was an integral foreign operation, then the branch generates cash flows and it transfers to head office. So, head office cash flow is also dependent on the branch cash flows. Whereas, if it is non-integral foreign operation, branch is generating its own cash flows. That is not flowing back on a continuous basis to the head office. I am not saying that they will never pay back the money. That's not the thing. The thing is that head office cash flow, they are managing independently. Branch cash flow, they are managing independently. There is no linkage between both of these. But if there is a scenario where the branch generates cash flows, transmits to head office, if this is happening on a continuous basis, then what we can say, these are integral foreign operations. Sale price of foreign enterprise are not affected by day-to-day change in exchange rate of reporting currency of foreign operation. So, for example, today the dollar is 100. Tomorrow the $1 becomes 110. Because of this, the selling price at branch does not change. Dollar and INR rate are changing, but the selling price in dollar does not change depending on the exchange rate. That means it is non-integral. There is an active sale market for the foreign operation product. So, these are some indicators. These are some indicators of an operation being non-integral foreign operation. See, we cannot decide based on only one condition. The management has to take a wholesome look at different scenarios and see whether this fits as non-integral or whether it fits as integral operation. Translation we have already done for both integral and non-integral. Integral, monetary items, closing rate; non-monetary, using the rate at the date of purchase. If revaluation model, fair value. Inventories at the exchange rate that existed when the cost of inventory was incurred, and realizable value is translated applying the exchange rate when realizable value is determined. What does this mean? If you are carrying at cost, take the transaction date. If you are carrying at NRV, take the closing rate. But generally in the questions what we do, they don't give us information, so we will take the closing rate for closing inventory, opening rate for opening inventory, and exchange difference is transferred to P&L. Non-integral, balance sheet, closing rate, income and expenses, average rate, and differences is translated is accumulated in foreign currency translation reserve. Then, as far as change in classification is concerned, if a non-integral becomes integral or if integral becomes non-integral, what is to be done? So, if integral becomes non-integral, then from the date of change, so earlier integral, now non-integral. From the date of change, we will follow non-integral accounting to translate the financial statement. Exchange difference on translation of non-monetary assets at the date of reclassification is accumulated in foreign currency translation reserve. So, what are we doing? On the date of change, see, till the date of change, we will treat it as integral. Exchange differences and all will be transferred to P&L. On the date of change, you will restate the trial balance considering non-integral foreign operation. On that date, you will get some exchange difference. That will be accumulated in foreign currency translation reserve. Now, coming to non-integral to integral means earlier it was non-integral, now it is integral. Translation procedure applicable to integral should be applied from the date of change. So, whenever the change has happened from that date, from that date you will say, okay, this is now become integral. Now, I will translate considering integral operations. Okay, what will change? Generally, your balance sheet items will change. because P&L we will apply average rate in both the cases. So your balance sheet items will change. So whatever is the balance sheet as on date of change, from this date you will apply procedures applicable to integral. Then translated amount of non-monetary items at the date of change is treated as historical cost. What does this mean? Whatever non-monetary items are there, the amount you get on translation on the date of change, you will consider that as if itself is the historical cost. So we will not go back and get the original cost, because balance sheet items we have been translating considering the closing rate year on year. Now on the date of translation, whatever is the translated amount of non-monetary items, say for example fixed asset, that we will say this is the deemed cost. This is the deemed cost for all future depreciation calculation, all future purpose of balance sheet. Then for non-integral, we have something called as foreign currency translation reserve. We have something called as foreign currency translation reserve. This will not transfer to P&L. We will keep it as foreign currency translation reserve. The date on which we dispose of the foreign operation, on that date we will transfer it to P&L. Okay, so that is about integral to non-integral and non-integral to integral classification, right? So that is about translation or changes from non-integral to integral and integral to non-integral. So with this we have completed all the relevant aspects of this particular chapter. Now we will do a quick summary of whatever we have learned, so that it becomes a good basis for your recap. And then there is a separate revision video which you are supposed to complete independently. Now as far as branch accounting are concerned, there are inland branches where we have two categories: dependent branches and independent branches. In dependent branches we can send at cost basis, we can send at invoice price, and sometimes we can send at wholesale price. For dependent branches we follow either the stock and debtors method, or we follow the debtors method or the P&L method. For independent branches we will largely follow the trading P&L method only. Independent branches maintain their own set of books. Now if we follow the debtors method, this is the most easiest method. What do? We will prepare the branch account. In the branch account we will take opening balance. We will take opening balance. Whatever head office has sent to the branch we will debit. Head office to branch we will debit. Branch to head office whatever we have received we will credit, and we will take the closing balance. Whatever is the balancing figure becomes the profit or loss. Now in this case, if goods are sent as invoice price, we are sending head office to branch at invoice price, immediately we will reverse the profit element as well. Okay, rest all things remains the same. Coming to stock and debtors method, here we will prepare stock account separately, branch stock account. We will prepare branch debtors account separately. We will prepare branch expenses account, and we will prepare the branch P&L account. Okay, whatever is the profit in the stock account will be transferred to branch P&L account. Whatever is the branch expense account, so in stock and debtors account largely we prepare the branch stock account, branch debtors account, branch expenses account. If requirement is there, we will also prepare cash account and all of those things, if at all we need to figure out some missing information. Then from stock account whatever is there, everything will be transferred to branch P&L account, the balance. From debtors account, branch expenses account, if at all there are any expenses, that also will be transferred to P&L account. Alright, so that is how we will do in the stock and debtors method. In stock and debtors method, if we are following invoice price method, then we open one more account called branch adjustment account. What is the use of this branch adjustment account? Any profit element that has arisen on goods sent to branch, goods received from branch, all of that it adjusted in the branch adjustment account. From this branch adjustment account, the balancing figure is transferred to the branch P&L account. Then we have the P&L method. In this, everything we do as if it is done on the cost basis. Whenever wholesale price method is given, there are two prices: cost to head office, wholesale price, and selling price. All the branch transactions we do considering wholesale price, and the difference between this cost and the wholesale price is adjusted through a stock reserve in opening stock and closing stock. There is a possibility that you get confused between invoice price and selling price and wholesale price. So before the examination, each method, one question, you should definitely try to solve it on your own. Then coming to P&L method, P&L method is a straightforward method. Everything is converted to cost and we prepare the trading and P&L. Independent branches, directly we prepare the P&L method. Then we talked about foreign branches, integral foreign operations and non-integral foreign operations. Here, translation of monetary items will be done at closing rate, P&L items at average rate, opening stock, opening rate, closing rate if other information is not given. Fixed asset, date of transaction. Non-integral foreign operation, P&L average rate and balance sheet closing rate. Difference here will be taken to P&L exchange difference, and in the NIFO exchange difference is accumulated in foreign currency translation reserve. Sometimes you may get questions of rectifications, goods in transit, cash in transit and all of that. So that also you have a look at the journal entries before going for the examination.